From a growth perspective, I think the message is mostly stable, but mostly low. Growth assumptions this year haven't really changed a great deal from the year before, but what's interesting is that we might just be coming towards the end of a long series of downgrades to growth. Crucially, this year we've actually upgraded a major region for the first time in about a decade. That's the Eurozone, which we've taken up 1/4 of a point. Also, what we're seeing is some potential upside over the long term coming from productivity, which would be driven by technological advancement. But for right now, what it means for asset returns is that the 60-40 point is down just a little, but the efficient frontier has rotated very slightly in a clockwise direction. Bond returns slightly higher because of higher starting yields, equity returns slightly lower, in large part because of where we are in the cycle, which means that valuations and margins are both taking those numbers down by between 1/2 and 1/4 of a point. We've put a lot of emphasis this year on our long-term secular themes, the themes that are going to drive growth and asset returns over the next 10 to 15 years. And there are 5 that we've homed in on. The first, demographics. This is one which already is reflected in our growth numbers, but here we're beginning to look at what an ageing population might mean for savings and for interest rates. One place where an ageing population is well flagged, of course, is China. We haven't looked at China purely from a population angle, though. We've looked at it from a financial markets angle. And we've asked the question as to how do we estimate longer-term rates of interest and longer-term currency projections for a country such as China. The third area that we've looked at is to think about the pension issues that we face. Many pension funds around the globe are underfunded, yet they still need to deliver on their liabilities. And this means seeking income from assets other than government bonds, reaching into credit, reaching into equities for those returns. Of course, when we think about this, it also matters for the dollar and what that means about capital flow globally. We've seen the dollar's drivers shift this year from being interest rate differentials to long-term growth differentials and capital flows. And understanding what drives the dollar is crucial for understanding longer-term returns. And then, of course, the last but not least, technology. It's a subject that's been under intense scrutiny over the past couple of years. And as we look at technology, it gives us some optimism for where we may see productivity rates go over the next 10 to 15 years. Well, this year, more than many that have preceded it, we're seeing a significant cyclical impact on our long-term return numbers. Now, of course, when we build our long-term capital market assumptions, we're looking over 10 to 15 years. But because we're late in the economic cycle today, bond yields are starting from a low point and equity valuations are relatively full. There is a cyclical component which is affecting those long-term average returns. And any investor, even those with a very long-term horizon, need to be aware that there are some cyclical issues to consider today. So for equity investors, it's valuation and margin, which is holding down those longer-term returns. And of course, for bond investors, the low level of starting yields means that there is a penalty on the average returns over our forecast horizon. But we would argue that today there's enough opportunity for active allocation and also for diversification to allow investors of many types to be able to work through the cyclical challenges and capture the longer-term secular returns.